So, what does the coronavirus have to do with interest rates? Directly, nothing. Indirectly, quite a lot. Hi, this is Andrew with the Andrew Smith team at eXp Realty. And if you've seen any of the videos or blog posts I've put out over the past several weeks or months, you know that we've talked about affordability quite a bit. And one of the things that, or one of the factors of affordability is interest rates. So, in light of what's happened in the past few days, I thought we'd touch on interest rates a little bit today. So, the coronavirus, interest rates, why did I lead with that? Well, the coronavirus, as mentioned, is not directly related to interest rates, obviously. But what has happened is the coronavirus has had an impact on the economy. And you probably noticed earlier this week, the stock market tumbled quite a bit. So the stock market dropped, and that was in direct relation to economic fears about overall output, production, and economic growth, especially coming from China. I mean, so many goods and products are produced in China, and with China essentially being closed, that was having an impact on the not only the local economy of China, but worldwide. Everything is so related, the availability of goods and what was being shipped out. That fear, economic fear, caused our stock market to drop quite substantially. Well, yesterday, the Federal Reserve cut interest rates by 0.5%. And they cut those rates to try and ward off any problems with our economy here in the United States, to try and help support that. And as a response, the stock market has come back in the last day or so. But when we look specifically at interest rates, and then we go and look at how does that impact housing, well, as I mentioned, interest rates are directly linked to affordability. It's one of the key factors. And interest rates have reached historic lows. I mean, they've been low for a while, and they've truly reached historic lows. I had an email come across my desk yesterday from a mortgage lender that had 30-year fixed rate mortgages at 3.125%. It's just unbelievable. I mean, it's astounding to me how low that rate is. To put it in some perspective, mortgage rates over the last 45 years have varied quite a bit. From a high of, get this, 18.63% in 1981. Yes, in 1981, 18.63% for a mortgage rate. All the way down to this email I got yesterday, 3.125. In general, across most lenders, I'm seeing rates anywhere from about 3.2 to 3.4 is what I've been noticing over the past few days. But when interest rates get that low, it has a dramatic impact on the cost of a home, how much money you're actually going to pay in the form of a mortgage. And if you click the link below this video where it actually will take you to my blog post, I've got a chart in there that shows, based on a $200,000 mortgage or a $200,000 mortgage amount, what those different interest rates actually mean and how much more affordable that mortgage is today than it was given the rates that we had in the 1980s. So what does this actually mean to you if you're in the market to buy? Well, if you're in the market to buy and you're actively looking and you're working and looking at homes, make sure you're in touch with your mortgage lender with regards to locking in your rate. You're going to want to talk to them to get their opinion and their advice on whether you should lock that rate now or let it float a little bit over the next couple of weeks, depending on how much time you have before that rate is actually locked in. If you're just starting your home search, then at that point in time, you really want to also talk to the mortgage lender, because the rate that you get approved at today may be a different rate in 2 months, 3 months, 4 months. So you're going to want to keep that in mind. I'm not expecting rates to change dramatically this year, but any change in rates could have an impact on your purchasing power. Here's what I mean by that. The National Association of Home Builders recently released an interesting statistic that if mortgage rates go up by 0.25%, it will take approximately 1.3 million households out of the market for a median priced new home. Okay, so think about that. That's just 0.25% change, and it can have a dramatic impact on that many people. Likewise, if you were on the fence about qualifying previously, a drop in interest rates, like what we have seen, can all of a sudden get you back into the market where you thought you were going to have to sit on the sidelines for a while. Now, if you currently own a home, depending on how long you've been in that home, refinancing may be an option for you. You may want to seriously give that some consideration. What you're going to want to look for if you're thinking about refinancing is what your current mortgage interest rate is. If you're currently at 3.5%, refinancing to 3.4% is not going to do you that much good. It's not going to make a huge difference. If you can cut your rate by 0.5%, 0.75%, or even a full percent, then you're going to want to start to look at it. But you're actually going to want to know what your break-even point is. Here's what I mean by that. Say that you do a refinance and the total cost, the loan cost of doing the refinance is $3,000. If it costs you $3,000 and your mortgage payment is going to go down by $100 a month, if you're going to stay in your home less than 3 years, it's not worth you refinancing. 30 months times $100 is $3,000. So the $3,000 you will have spent to refinance, it's going to take you 30 months to recover that at $100 savings, just as an example. But if you're all of a sudden you've got a larger savings in, and you really don't think that you're going to be moving anytime in the next 4, 5, 6, 7 years, it may very well be a time for you to consider a refinance. If you've got any questions about your specific situation or want to talk through anything in more detail, please shoot me a message, email, give me a call. I'm always happy to talk and share whatever insights I have with you so that you can make the best decision for you and your family.